A chip maker sell-off to start your morning, 30 minutes until the start of cash equity trading. I'm Danny Berger.
And I'm Bonnie Quinn. Bloomberg Open Interest starts right now.
Coming up, Samsung's record profit fails to impress, dragging down global chip stocks.
Meanwhile, SpaceX wins some bullish ratings from Wall Street as it joins the Nasdaq 100.
And tensions flare in the Strait of Hormuz as President Trump arrives at the NATO summit.
All right, well, we've got some stocks to watch. We'll get straight to them. And as you might imagine, they are chip makers, mainly memory chip makers. They're taking the brunt of the Samsung earnings. Obviously, Samsung revenue more than doubled last quarter. Earnings were 19-fold what it had earned the previous quarter, and still the stock was lower, and that's bleeding into the US session. Investors may be profit-taking, though. Demand for AI chips creating enormous pricing power for these firms, and it's bleeding into other chip stocks too then.
It's amazing to see such strong results and that sell-off. It seems to be a theme for this market. We're also watching SpaceX today, Vonnie, because it's joining the Nasdaq 100. It's going to account for just over 1% of the index. At least 6 analysts have initiated coverage of the company with a buy. This was the best one. I don't know if you saw this, Vonnie. Morgan Stanley has a street high price target of $300 per share, but their space business is only worth $9 of that. So it's everything else that's going to propel this thing higher, apparently.
3% of the valuation is thanks to space business. That's because it burns so much in its space business, I think, Danny, is the problem. All right, let's get into the chip sell-off with Bloomberg Tech host Ed Ludlow. So, Ed, this began with everybody saying, oh, but it's Korea, and Korea is leveraged, and there's lots of retail traders, and it's so, difficult to predict.
Right.
But this is more than just two Korean companies at this point, right? This is a turn in sentiment.
The Korean market has been difficult. I think a guest on Bloomberg Surveillance earlier called it very messy for the reasons that you've outlined. But essentially, nothing's fundamentally changed. So you went through the Samsung numbers. They were very good. It's also a stock that was 150% up year to date going into it. And what they told the market was, the situation's the same. Memory supply is very tight. Importantly, DRAM and NAND pricing continues to go up. And on the other side of 2027, they don't know when that's going to improve. So the market probably looked at this probably on a valuations basis and said, we've had enough for now. And by association, all those peers here in the United States are down as a result. But fundamentally, nothing's changed. The story is exactly the same as when the three of us all went to bed last night.
I mean, if you think market concentration is bad in the U.S. and South Korea, it's obviously way, way worse. Speaking of market concentration, it's also been interesting to watch this bond market become increasingly tied to the fortunes of tech players. We had a new issuance from Amazon today, already having borrowed, I think this is the second time this year, already having issued more than six.
March was $37 billion, maybe up to 50, and now they're coming back for $25 billion per Bloomberg reporting.
Does this just suggest that they're going to spend even more than they had originally guided if they're tapping these bond markets again?
The bullishness from Amazon's leadership on CapEx has been pretty consistent. If you go back to April 29th when they reported earnings, they didn't mention their need to borrow at all. What they said was that there is a short-term impact on cash flow, which everyone is sanguine about. The idea, like a few years ago, that Amazon would tip into negative free cash flow, everyone would freak out. Right? When Oracle tipped into negative free cash flow, everyone did freak out. With Amazon, it's a bit different. But the way that they've guided it is that this capital expenditure will result in massive cash flows and revenues, and that they can see that. So they justify it. I think there's a lot of mechanics to work out, like how much is CapEx going to be next year relative to this year, and are they done borrowing for this year? But when you have the balance sheet that Amazon does and the operating income of AWS, the market kind of cheers it. And I think BI, for example, is very bullish. That CapEx number will go up.
This is it. Well, this chip trade, Ed, I mean, they're essentially commodities, right? Whether they're memory chips or other kinds of chips, they're pretty commodity.
Are they? Huh? Are they? Well, so historically, memory chips are boom and bust, right? They are highly cyclical. And when you look at Samsung, for example, if you want to go back to that, maybe the disappointment here is margins. Margins have been very high. But in any cycle for memory, they're never maintained. They ebb and flow. They go down after a while.
My point was, can DeepSeek make one and take some of the market? OK,
so the DeepSeek one is really interesting. The Reuters story hit that DeepSeek is working on an inference chip. And NVIDIA, in the pre-market, had a tangible move lower. You can see it on the tape. What I would say is that everyone and anyone in the world of AI, particularly a growth scale company, is working on custom silicon, because the environment right now is that everyone is compute constrained. They cannot get enough chips. or get the chips that they say they need to run workloads. The main distinction is that DeepSeek is, with respect, a teeny tiny company. They raised $7 billion in June, which is mightily impressive for a maiden raise, but it is nothing in the scheme of things. A custom chip takes anywhere from 18 to 36 months to go from architecting it to actually printing the silicon, if you have a very good team of experts and decades of experience.
But who knows who they've contracted in China?
And who knows,
We'll
right?
never know.
The Reuters report had literally no details, no timeline, nothing other than this is an inference chip and they want to diversify away from NVIDIA. Yeah, so does everyone else.
Yeah.
Because right now, NVIDIA is the only game in town with a technical monopoly.
All right, Ed.
That was fun.
Thank you so
Thank
much.
you.
Very fun. We'll do it again a little later. Bloomberg Tech host Ed Ludlow. Walmart, meantime, is cutting prices across grocery, household, essentials, toys and apparel as it aims to attract cost-conscious customers. President Trump praised the move and signalled other retailers should follow Walmart's lead. Bloomberg Managing Editor for Global Business Coverage, Craig Trudell, joins us. Craig, regardless of whether President Trump made the call or not, Walmart was doing this. It was always going to do it. It always does this. It's the home of the low prices, right?
Yeah, President Trump may have had more to do with getting a U.S. player back on the pitch last night than this announcement. But
we can't bring that up.
But
it's too soon.
but clearly, the president got a heads up about a release that the company was putting out on sort of something that, to your point, they do every year around major events, holidays, and we've seen the president do this actually with Walmart just in November of last year around the Thanksgiving holiday, where sort of an announcement about promotions around turkey prices contributed to sort of the president's messaging about trying to get prices down for consumers. In the grand scheme of things, however, Walmart has been actually increasing prices. The ground beef that the president mentioned in his True Social last night, ground beef prices in the U.S. are at a record high. So some counter-programming here going on from the president with some major caveats.
I remember earlier in the year, Target, for example, slashed prices too. And I wonder at this point in time if Walmart is in the position where it can, because it has such a big part of this market, its margins are still healthy. Can other retailers follow along the path that Walmart is engaging on?
I think we're hearing Kroger, very recently talk about how they're going to be willing to, adjust pricing to go after Walmart. So maybe we are seeing, a peak in grocery prices. But I think, sort of that being said, with Walmart, they're actually moving to sort of digital pricing model, which would perhaps allow for them to sort of, opportunistically here and there adjust prices. But when
are you saying dynamic pricing?
Yes.
Oh, that is terrifying.
So
they're going to look at your card and see if you buy organic and then charge you more for even
exactly. So headlines, you can sort of make these announcements about bringing prices here and there, but in the grand scheme of things, we consumers may in the end still be paying more.
By the way, what happened to Team USA last night, Craig? They looked so nervous.
It was tough. It
was hard viewing.
It was they looked like they had maybe sort of gotten away with a little something.
I think you're probably right.
Belgium's not a bad team. I mean, they are the fifth best team in Europe after all.
Yeah, but USA is supposed to have the 12th man on the pitch with the whole crowd and all of that. Craig, thank you so much for joining. Always a pleasure to see you. Bloomberg's Craig Trudell. Elsewhere, President Trump has arrived in Turkey for the NATO summit, where allies are unveiling billions of dollars in defense deals. Trump currently meeting with Turkey's President Erdogan. You see Trump there at that NATO meeting in Turkey, in Ankara. Trump says he will make a decision on whether to sell F-35 planes to Turkey. Joining us now from Ankara is Bloomberg chief political correspondent and surveillance co-host Anne-Marie Hordern. Anne-Marie, what are we expecting today?
Well, I think the big news out of this Erdogan bilat, of course, especially for Turkey, is this path, the intent that the U.S. has to have the ability to send the F-35s to Turkey. Of course, they've been blocked, and it's blocked by law that they cannot buy the F-35s because, of course, they already bought into the Russian defense system, the S-400s. So right now what you see is Trump showing that intent, which was highlighted in numerous reports overnight, including the New York Times. But there's going to have to be some work workarounds because this would have to go through Congress in order for it to be legal. So for Turkey, that would be a huge welcoming sign from President Trump, who recently said he was only coming to this NATO summit because of how much he respected Erdogan and wanted to come for him. The president right now, of course, has a lot of frustrations with European allies that are part of NATO. This is on the heels of what happened earlier this year. Davos was really taken over by the Greenland comments. Of course, what is going on in the conflict in Iran, that is going to be a top discussion, especially given the fact that a Qatari vessel was hit today. Really important given the fact that Qatar is a mediator in these discussions. And the president's latest frustrations with a lot of European allies is the inability to use, say, Spain's airspace when conducting strikes when it comes to the conflict. And finally, of course, the president will have a bilateral meeting tomorrow with President Zelensky, who in a Financial Times interview talked about how the next battle is the battle for the air. And a big discussion amongst NATO and European allies is going to be whether or not they can give Ukraine more Patriot defense missiles. There's been one issue that's been discussed now for a while, was discussed again at the G7, and potentially the group would make headway on, is that maybe they can give a licensing agreement to Kyiv for them to be able to manufacture some parts or a complete defense system within countries. So that's going to be a huge topic tomorrow. All of this comes under the fact that the United States right now is in the midst of a 6-month review of their presence and posture when it comes to the alliance and their defense posture when it comes to troops in Europe writ large.
Anne-Marie, how does Europe and the various heads of European states, how do they placate Trump? He's speaking right now and basically saying Turkey helped the US to try and end the war with Iran, but other countries didn't, and he's specifically naming France, Germany and others. He also, by the way, is saying that Greenland should be controlled by the US again.
So I think there's two ways to think about this when the United States asked European allies for help when it comes to Iran conflict. There are some that raised their hands, and there was an ABC report of how an official talked about this, raised their hands and wanted to help, but didn't have the hardware, didn't have the ability to do so, which is why you have the NATO Secretary General Mark Rutte talking about this summit being a defense industrial revolution for the transatlantic alliance. It's about building on last year's summit when they all agreed to hit 5% of GDP when it comes to defense spending. 3.5% of that would go to hardware, ammunition, things like maybe minesweepers that could have been used to go sweep the Strait of Hormuz and help the U.S. Fifth Fleet. The others are just individuals who maybe even if they had the ability don't want to help the United States in this moment. Maybe that is Italy that was closing air bases, France, which was not allowing the U.S. to use their airspace when conducting the Iran conflict. And that is why when it comes to the conflict of Iran, this has been really the latest source of frustration between Washington and Brussels.
Anne-Marie, thank you so much for your reporting. Bloomberg's Anne-Marie Hordern at the NATO summit, and we're going to catch up with Anne-Marie later in the show. She'll be speaking with Finnish President Alexander Stubb, and we'll also bring you an interview from the EU's foreign affairs chief. Let's get a check on markets just over 15 minutes before we begin cash equity trading, and it's the Nasdaq. It's a narrative that keeps flipping on its head every day. One day semis leads us, the other day it drags us lower. Today, it's the latter after Samsung earnings that were stellar, but not stellar enough. The 10-year yield that moves higher by about 2 basis points, considering oil is moving higher after an attack on a Qatari ship in the Strait of Hormuz. Some of the other movers on our radar this morning, Fiserv climbing on a report that big banks are showing interest in its debit network. Bonnie.
And Rivian selling 75 million shares to fund equity contributions related to a $4 billion U.S. Department of Energy loan. As you can imagine, shares are lower off the back of that news, down almost 12% now, Danny.
And we were just talking about this with Ed Ludlow. Amazon raising at least $25 billion in an 8-part U.S. bond sale this week to fund its AI spending. And shares are fine. Shrug it off, even though treasuries are slightly weaker, too. On that news. Coming up, we talk more about tech, specifically SpaceX is going to be joining indexes less than 1 month since going public, and some investors are finding ways to limit exposure. We discuss next, right here on Open Interest.
Now to high interest to look at what's making headlines around the world. Marine Le Pen is officially back in the race for the French presidency next year. A court has upheld her embezzlement conviction for misusing European Union funds, but shortened her election ban to 15 months. That clears the way for her to run. She can still appeal the ruling. The USA is out of the World Cup after a 4-1 loss to Belgium yesterday. The match was overshadowed by FIFA's controversial decision to overturn Folarin Balogun's one-game suspension, drawing sharp criticism from Belgium and from European soccer officials. Belgium's national team got the last word on social media, posting, "Overturn this." The country now advances to face Spain in the quarterfinals next Friday. And SpaceX joins the Nasdaq 100 today as Wall Street launches broadly bullish coverage following its IPO quiet period. Analysts are focused on long-term growth in satellites and AI services, though concerns remain around profitability, execution and valuation, Danny.
Bonnie, though not everyone is buying the bull case, some investors are asking money managers to keep it out of their portfolios because, well, CEO Elon Musk has become increasingly a polarizing public figure. Joining us now is Ellevest Head of Wealth Management, Emily Green. Her firm uses direct indexing as a solution for clients who want to limit exposure to specific names. Emily, thanks for joining.
Thanks for having me.
And look, it's a perfect day to have you on because SpaceX is joining the Nasdaq 100. How big of a conversation is this with clients who are coming to you to say, hey, I want the Nasdaq 100, give it to me, but strip out SpaceX?
Yeah, I mean, I think we know people want to own tech. And so people want they want to own the QQQ, they want the Nasdaq 100. I think the fear that people have is how big of it is. And they don't really understand the concept of the float and that it's not actually going to be, today it's probably like 1% that it's going to be of the Nasdaq 100 today. That's going to be a bigger and bigger conversation, I think, as the lockups come for these early investors and employees and so on and so forth. But it definitely is a controversial stock for people to own. And I think there's people who really believe in it and there's people who are really against it.
Sure. Now, are you actually getting calls from people who want out because of that one stock? And are there other stocks that make people want to do that?
Oh, definitely. I mean, we have, especially pre-IPO, before it went public, we had a lot of people calling us and saying, it'd be interesting. They ask, how much exposure will I have? Which it's going to change over time. It's, it's as they come into the different indices and such. But we do have people who are calling us and saying, how do I make sure I don't have exposure to this or my exposure is very little? Is
it a valuation exposure problem or is it, an ethical, moral? I mean, because you have Palantir in there, for example.
Yeah, I think it's a little both. I think that Elon is very, that the people have big feelings about him. He's very polarizing. And so there's people who really believe in him and people who really don't. I don't know if we'd be having the same conversation if someone else was the CEO and founder of this company.
Yeah.
And so I think it is interesting.
Well, you pointed this out to our print colleagues, and we were talking about it in the break, that a similar thing happened during Meta in the 2016 election. But then if you had stripped out Meta, you would have missed out on a stock that went on to reach new highs.
Yeah.
How are you handling that conversation with your clients to say, yes, there are some concerning things, governance-wise, maybe ethically, but if you strip it out, you could be losing out on gains?
Yeah, at Ellevest, we really think about, we're going to show people what that means. And so we do a lot of direct indexing, so basically building personal index funds for people. And so you can take things out of your portfolio if you want. It is just showing them, okay, this is what it may cause. This is the tracking error that may be. This is what, are you willing to do that? And, it's their money at the end of the day, and trying to help them take the emotion out of that decision of, SpaceX may be the name, it's what's in the news. There are also a lot of other companies, to your point. There's the Palantirs. There's a lot of things that people don't talk about every day that actually maybe do worse things, and kind of like showing them the data of what that's going to mean and what that may mean from a portfolio for a good or bad perspective in the future. Because, we see these big price targets for SpaceX, but we know there's a big hurdle for them to actually get into the valuation that they have today.
Yeah, it's true. I mean, Bonnie and I were talking about Morgan Stanley giving them a $300 price target, and only 9 of that being space. So we're in this environment where it joins the Nasdaq 100, and passive investors are buying it, whether willingly or knowingly or not, very soon after this thing lists. A lot of them changed their rules to allow this to happen. Do you think, in general, for more wealth kind of retail-oriented investor, that this is a problem, that they don't maybe fully realize sort of the dynamics around the stock?
Yeah, I mean, I don't think people understand the changing of the rules, that it's becoming part of like the Nasdaq 100 so quickly. For example, you know, the S&P 500 obviously did not bend the rules, and so we're still going to see that that's not in there. And people don't understand what it's going to be in and what it's not going to be in right now. At the end of the day, you know, these indices are broad. They are, though, much more concentrated than they used to be when we look at these tech stocks. It's a different world. And I think as more float opens up and as SpaceX, you know, we see more shares available, it will be a bigger part of this. And I think it is a conversation for people to think about, especially when you look at what the valuation is at and frankly, the profitability and the spend of that company.
19 buys now, and all the price targets are above where it's trading at currently. Emily, we have to leave it there, but thank you so much. Ellevest Head of Wealth Management, Emily Green, joining us. Coming up, more on the AI trade volatility with Envestnet's Dana Dioria. This is Bloomberg Open Interest.
Let's get a check on equity markets. A few things to digest ahead of the opening bell in 5 minutes. For one, Samsung earnings that were strong but not strong enough dragged down chip stocks, along with DeepSeek looking to build its own chip player. So all of that dragging semis down. Plus, we have Amazon issuing a huge bond offering that weighs on 10-year yields, which move up by 3 basis points. Also weighing on 10-year yields is Brent crude up 1.6% after another ship getting struck in the Strait of Hormuz. Vani.
All right, Danny, let's get a look at some other movers on the radar. Nvidia shares declining today as that AI trade broadens out from the Magnificent Seven and investors take profits.
Vertex, a deal for them, buying Crinetics in a $10 billion cash deal. It will help their product line for rare genetic diseases.
And Philippine Airlines plans to order Boeing jets for the first time since 2007, according to people familiar with the plan. It plans to buy 10 jets as part of a multi-billion-dollar deal.
Coming up on the other side of this break, we will have your market open. This is Bloomberg Open Interest. Here we go, moments until the start of trading. This is Bloomberg Open Interest. I'm Danny Berger. Yesterday's gains turned to a decline. We are still within 1% of all-time highs. If this sticks, we're obviously not going to get there. The equal weighted, though, did hit an all-time high yesterday. We're dragged down by the Nasdaq, down 1% as chip makers falter. They were once the heroes of this market. That changes today as it seems to flip every day. The Dow, though, that is up 0.5%. Ringing the opening bells, we have IBM down at the New York Stock Exchange. What a ride it's been for them. They've had that huge run up in May after they got U.S. funding. It's flatlined since then, kind of petered out some of the gains. Down at the Nasdaq, we have Climb Global. They're basically a middleman for IT solutions, if you will, so software. So they were a penny stock. They have a huge rally up, something like 360% in the past 5 years, but they're down now about 6% year to date. Because they do software, and software is pretty tough. But they have their investor day for 2026 today, and they're celebrating that, Bonnie. And let's get some of the stocks to watch this morning. And as I mentioned, a lot of it is the chip stocks. Chip makers are largely down today. Samsung revenue more than doubled last quarter. That is not enough, though. Expectations are so high. Samsung is such a big part of the Korean market, so you only need a little bit to tip it over. Micron, Intel, Western Digital all down at least 5%. There's a lot of profit taking as demand for AI chips creates enormous pricing power for these firms. And at the same time, we're also seeing DeepSeek trying to launch one of their own chips, so that's also weighing on things.
Danny, SpaceX joining the Nasdaq 100 today. It'll account for 1.3% of the index. At least 6 analysts newly initiating coverage of the company today now with buy ratings. Morgan Stanley has a street high price target of $300 per share. Joining us now is Envestnet Co-Chief Investment Officer Dana Dioria. Dana, is your impression of the Nasdaq 100 different today than it was yesterday in any way for your clients or for your outlook?
No, it hasn't changed. I think we're experiencing what has become a familiar story at this point with, kind of this push and pull of fear and greed in the market as it relates to the AI trade, to software, to chips that, power the AI trade. And so it's not surprising that we see these ups and downs. You've got this massive, potentially, current or, future AI productivity story that will absolutely change economics, right? So you have this huge, new productivity story that has to be priced, and it's very difficult to price. And it's difficult to know, when that's going to come through, who are going to be the winners, how long will it take? And so you just have the market reacting to any incremental little noise.
How do you handle that, though, Dana? Are these dips that you want to buy? Because it feels like every other day we're just flipping back and forth whether we like chips or whether we don't like them.
I mean, you're 100% right. The market is based around, one price, right, for every stock. And so anything that is a variable that might move the price of that stock, whether it's idiosyncratic to that stock or systematic related to the trade, you've got one price to reflect all of that information. And so in a situation where you have this sort of towering amount of pricing that has to be done, sort of like the glacier, right? Most of it is under the water, and all you have is that one price to reflect that. It's very difficult. And I think, from the perspective, the sentiment of the question is, how do the investors work with that? I think it's not easy. If you're an advisor, kind of working with retail investors, on the one hand, you want to try to diversify, right? And we're seeing the benefits of that this year with small caps for sure. Diversification is really paying off this year in a big way. But on the other, when so much of the market moves with this concentrated bet, it's really hard to keep a client disciplined if you have a lot of tracking error to that bet.
Are you happy being all in the Nasdaq 100, given that we're up 18% year to date? And sure, the S&P is up, 11, 12%, but that's still a good 6%. And, on any given year, a client might be happy with just 6% on its own, Dana.
It's true. It honestly depends a lot on what is the benchmark that, the client has been looking at and the advisor has been sort of, directing the client to look at. It's you have advisors who will show the S&P 500, which is a tough benchmark, right? Especially in this day and age because it's so concentrated. Nasdaq is not typically a benchmark that, somebody's going to say, here's your retirement assets and we're benchmarking against the Nasdaq. But it's certainly something that can kind of goose the return to the point, right? In terms of what you're getting from the overall index. And so I think, then you have MSCI. I mean, a lot of good financial reporting to the client will show a variety of indexes. If you show something like a world index, you generally tend to be a little bit better off because it's a diversified index and they're not seeing concentrated wins and losses in one benchmark.
When it comes to concentration, Dana, the credit universe used to maybe give you more financials, something a little bit different than what equity indexes are. Every day that feels like it's changing. And today it's Amazon with the $25 billion debt offering, already having raised $60 billion worth of paper so far this year. What happens when investment grade and the corporate credit market in general starts to get more tech concentrated?
Yeah, and not even just U.S., right? We know that these big tech companies are going overseas, and this trade is now penetrating. It's an insightful question. The trade is now penetrating parts of the market that traditionally you would have said, this is ballast, this is an area where I'm sort of protected from the vagaries of what is going on in the equity markets. But there are ways to continue to diversify, right? And it does require more of a deep penetration in terms of how you're looking at those different options. And, whether it's extending yourself out to private credit areas, which themselves have to be looked at because, they can sometimes tend to have a software bias. But, these different areas of the market that are now available to clients, different bonds, different, the good news is ETFs, if you want to just go with a packaged product, ETFs cover all sorts of parts of the market. You can certainly go to an ETF and find one that's sort of less dependent on, the AI trade or the software trade. But it does require, it's not a matter anymore of just buy the market and, kind of feel safe and diversified. It requires a little bit more of a look if your thought is, hey, there's a concentrated bet here that's penetrating across my holdings and I need to diversify away from that.
I mean, Dana, the Dow actually hit a record yesterday, and in recent weeks we've been seeing the Russell 2000 hit records and also the equal-weighted S&P 500. Is this a fear trade, a fear that we've way overpriced some of the chip space, Or is it, a confidence trade that some of the other areas of the economy are mighty strong, and we'll see banks and insurers and industrials and all of the other wonderful sectors in this economy doing better?
It's, so the hopeful narrative there, of course, is that we're seeing actually benefits. So this isn't just about the creators, the producers of AI as it relates to the AI trade, that we're seeing, and we do see signs of this in corporate profits and margins kind of increasing, that some of the productivity is now penetrating out into the rest of the market, and that this really will lift all boats, right? And that there's an opportunity set here for different parts of the market to be winners, using this technology. And so I think there's sort of a hopeful narrative here that, it's the latter, so to speak, right? That the market is pricing in the expectation that you're going to see benefits in these other businesses, and these other businesses had not been enjoying the valuation levels that the producers, if you will, of technology and AI componentry were experiencing before. And so now you're seeing a lift in those other parts of the market. Obviously, there's also, interest rate speculation, certainly small caps in particular. You mentioned the equal weighted, which really is a small cap index at its heart versus market cap. That's going to be benefited obviously by the hope that interest rates stay lower, because certainly we know that small caps are more dependent on floating rate debt, and so what goes on with the Fed is going to impact those as well.
Dana, this has been so interesting. Thank you so much for joining us this morning. That's Envestnet's Dana D'Auria. Let's get a check on your equity market about 8 minutes into your trading day this morning. And we are moving lower, but look at this breadth. This is something we consistently see. Almost 400 stocks are trading higher, yet we are lower. Yesterday was exactly the inverse, in that this equity market gained, but majority stocks were moving lower. It's, again, an inverse in multiple ways. Also, yesterday was a lot of the riskier stocks that were doing well. Today, it's a lot of the safety stocks. Save for Microsoft, which is a tech company. You get a lot of healthcare in there. Eli Lilly and Johnson & Johnson are near the top. You have some consumer staples with Walmart, P&G, and there too Coca-Cola, one of the big gainers today. And what is dragging us down? It should be no surprise. Vonnie and I have been talking about this. It is the chip makers after that Samsung earnings. Micron, AMD, Intel, Broadcom, Applied Materials, all sinking. Some of them more than 8%. It's a painful sell-off and dragging the entirety of the index down with it. So for the sectors, again, we're going to have a push-pull in tech because chip makers aren't doing well, but some of the bigger hyperscalers are rallying today. It's not enough to save it, though. Tech down 2%, followed by industrials. And as I mentioned, it's the safety stocks that are doing well. The inverse of yesterday, consumer staples and healthcare round out the top of the list. Energy having a good day, too, Vonnie, as the price of oil moves higher because of a new strike in the Strait of Hormuz, this time on a Qatari-flagged vessel. So that's sending interest rates higher alongside the price of oil.
Exactly. This is not a fragile market except in one area, Danny. Thank you. Coming up, Amazon targeting a $25 billion bond sale to fuel its AI build-out. We'll have details next. This is Bloomberg Open Interest. Time now for our top calls. Some of the analyst action we are watching this morning. First up, Wall Street bullish on SpaceX with Goldman Sachs, Morgan Stanley, RBC, Stifel, all citing its leadership in rockets, Starlink and AI. Interestingly, Morgan Stanley says the launch business accounts for just $9 per share of the $300 price target that it has put on it, with most of the valuation tied to Starlink and AI. Next up, Bank of America reinstating Adobe with a sell rating, saying the company is, quote, fundamentally challenged by AI as lower barriers to content creation increase competition from lower cost alternatives. Not having too much of an effect there. And finally, Scotiabank upgrading Cloudflare, citing AI-driven growth and stronger cybersecurity demand. Also not having an impact, Danny.
Thank you very much for those, Vonnie. Elsewhere, Amazon is raising at least $25 billion in U.S. bonds to fund its AI spending, which Bloomberg Intelligence says could top $300 billion of capex next year. Let's discuss with Bloomberg Intelligence credit analyst Robert Schiffman and Bloomberg Tech host Ed Ludlow. Robert, on this deal, not every day, I'm exaggerating. It feels like we have some hyperscaler coming to this bond market and tapping it. And for the most part, maybe we put aside SpaceX, the market absorbs it. How far can these companies take it? How far can they increase their leverage before we start looking at things like credit downgrades?
I think you better get used to having me on set because we're going to see a lot more of this.
Which is a treat, by
You
the
could
way.
just ask, Robert.
We have said this over and over again. The biggest hyperscalers I would consider to be on the Mount Rushmore of credit. These are AA and AAA names that have hundreds and hundreds of billions of capacity. Somebody asked me this morning, what would it take to have one of these names go to junk? You're talking a number that would be, I think, over $1 trillion. Wow. So I just think that what we're seeing here, supply continues to fall well behind demand. Spending is going up, and the only way to spend is to borrow more money.
Do they borrow at fixed rates, or what happens if the Fed does have to hike a few times?
Yeah, well, primarily all this extended duration borrowing is all fixed. So now you're locking in costs for 10, 20, 40 years. Remember, Alphabet did a 100-year bond via pounds a few months ago. So you don't have to worry about rates necessarily going up, other than why not borrow now if you think rates are going up? It's actually an incentive to come to the market sooner rather than later and lock in these deals.
Ed, that's the debt side. For how long can the equity side hold up? Because there does seem to be this narrative emerging saying you need to have a return on this investment. You can't keep spending without any fruition coming from it.
The equity side is much more closely tied to, is Amazon or AWS in particular good at AI, right? And they've kind of demonstrated in more recent history that they are, or at least the market gives them credit for it. You know, the thing about what Schiff outlines in the Bloomberg Intelligence React, I find fascinating, which is if CapEx is going to be $200 billion this year, why would it jump to $300 billion next year? And the way that Amazon explains it away is not necessarily that you have to keep building data centers to meet with that AI demand. CapEx can also go up because the cost of building data centers goes up, right? That has nothing to do with AI at all. There is construction labor inflation. We know there is great memory price inflation still, right? We're very focused on this idea that memory supply is tight. Continue to look at memory pricing. And so that was so interesting when he published the React. And the thing about it is that Andy Jassy tried to explain that in the prior earnings call, April 29th. They said it several times. Capital expenditure growth is outpacing revenue growth. And so to answer your question, we still don't see that accelerating AI revenue growth at a level where you're like calm about it on the equity side.
But every time we see something that's going to interfere with this cost, isn't it going to jolt the market? Like, for example, when NVIDIA said there was going to be a delay with its server racks.
Well, NVIDIA didn't say it. SemiAnalysis said it, and NVIDIA came out and pretty robustly rebutted it. You know, the reality is right now is that there is a big distinction in the markets between the capital expenditure deployers and the capital expenditure recipients. The recipients, for the large part, are the chip makers. And somewhere in the middle, to Danny's question, is show me something, a real tangible metric that shows you are making money from AI. And in Amazon's case, they can point to AWS top-line growth, but they also have this metric which they call AI revenue run rate, which is basically all of the things they do sort of linked to AI packaged as one thing. It can be people running AI workloads on their cloud compute capacity. It can also be the training of models and then the deployment of those models, inference. The reality is that they're still supply constrained on the compute side. So while that activity ramps, they also have to build more data center to accommodate for it. It's just the math on that and the cost of it, it's fluid and changing all the time.
Robert, what's made SpaceX different? This is a debt that has been trading lower, that has been largely disappointing to the market. Why hasn't that been as well absorbed as the rest of the hyperscalers?
Well, they're not part of the Mount Rushmore of credits. You know, SpaceX is a BBB name that doesn't have a real...
Pretty good.
It doesn't have it's high grade, but it doesn't have a very long history of generating any profits. So it's negative free cash flow. People are wondering how much funding it's going to take over the next handful of years. And because you have such key man risk, what does he actually even want to spend on? You know, when you look at SpaceX's mission, it scares people about talking about raising interplanetary experiences. So listen, I think a lot of that is just sort of hype. But there's a difference between BBB and BB hyperscalers that are building data centers that need to borrow money versus these very well capitalized, low leverage names that generate tons of profits in other businesses that can help finance the build out. And listen, from the equity side, just remember, I actually think that this is a positive sign from Amazon versus issuing equity like Alphabet did a few weeks ago. because the weighted average cost of capital suggests you should issue a lot more debt. But also, I think the leaders of these businesses, I'm sorry to say this, I don't think they care about their equity price right now. If they cared about their equity price, they'd be cutting CapEx.
But doesn't a robust equity price allow them this cheap cost of capital? I realize the bond markets are still holding up, but doing things like issuing equity, isn't it important for them that they continue to see rich valuation?
Well, like a completely separate case study is Rivian, right? That is just being opportunistic because in the 5 days since they had delivery numbers, the stock went up significantly, but like relative to basically the stock went up and they're like, you know what we should do, guys?
Dilute.
We should do an offering and raise some, and they did, but that's different spectrum, you know, to other end of the spectrum to Alphabet. Sorry, I just was like,
and then on top of
crazy.
This, SpaceX raised $85 billion of equity, you know, that cushion didn't provide that much backdrop to hold up bonds. You know, they widened in the aftermarkets. I just think that spending is going up. It's not going down, and it's going up more than what the equity community wants to see. They want to see returns.
Right.
Well, wake up. You're not going to see them in big size for the next 2 or 3 years. You're just going to see more spending, and we're going to be in this circular reference of when are we going to see it? They're spending more. Demand exceeds supply. And what does that mean? It means more question marks, more volatility. From the credit side, though, these credits are fine. There's tons of capacity. They can do it at super low costs. And bondholders are willing to fund this because they know over time credit quality is very likely to hold up.
All right. Thanks to Robert Schiffman of Bloomberg Intelligence. And also, of course, Bloomberg Tech host Ed Ludlow.
Coming up on the show, Finnish President Alexander Stubb will be joining us live from the NATO summit in Ankara, Turkey. That's coming up next. This is Bloomberg Open Interest. Let's head to Ankara, where NATO leaders are gathering for this week's summit. Bloomberg chief political correspondent and surveillance co-host Anne-Marie Hordern is there with Finland's president. Anne-Marie.
Thank you so much, Danny. That's right. Fresh off his meeting with President Volodymyr Zelensky and the host of the summit, President Erdogan, I am joined by the Finnish President Alexander Stubb, also known in the American press as the Trump Whisperer. Thank you so much for joining us here.
My pleasure.
So give us a sense of what this meeting you just came from with President Zelensky was like, especially given the fact that he's saying the next battle is going to be in the skies and he doesn't have enough defense systems.
Yeah, I think there are two elements to it. The first one is that he's doing quite well in terms of long-distance strikes, both drones and missiles. We're seeing Russian oil refineries being hit and 40% of their refining capacity going down. But the other part of it is the way in which Ukraine defends itself. And there he's absolutely right. He needs more air defense. He needs more Patriots because we're seeing over 100 civilian buildings being hit just the other night with civilians dying. So this is something that we Europeans and Americans need to work on.
Those long-range drone strikes, do you think that's making Russia more emboldened, or is it maybe, do you think, going to push them to a negotiating table?
Well, I think our assessment in Finland as Russia's neighbor is to understand that economic disparity won't end this war. The situation on the battlefield, in other words, the losses of Russian soldiers, 35,000 a month, is not going to end this war. But the strategic thinking of the Russian regime will change if the Russian population begins to be against the war. And that's what's happening right now. And the reasons are many. It's actually coming too close to home, hitting St. Petersburg and Moscow, the Crimean Peninsula, so it's hitting, kids, basically not hitting, but affecting children's summers. It's, they're closing internet. They have long lines at the gas pump. So these kinds of things will probably make Russia reconsider and hopefully get them to the negotiating table.
You are regarded as one of the closest European leaders to President Trump, a golfing buddy sometimes with him. What would your advice to Zelensky be on how to approach the United States with these requests?
Well, I think President Zelensky and President Trump are having a really good dialogue right now. And of course, things went off track because of Iran for a while. But now that we are back on track and we see the rhetoric and the meetings they had at the G7 meeting, the phone calls that they've had before this NATO summit around the 4th of July, I think we're going in the right direction. And I think there is a fundamental understanding of the American administration that Ukraine is right now on top, and it's always easier to back a winner than a loser.
Do you think at some point, this has been a talk for months, maybe even years, that the U.S. would allow Ukraine to just produce Patriot missiles in country?
That would be very useful because what
Are we close?
I hope so, because I mean we have to understand that, you know, Ukraine needs NATO, but NATO needs Ukraine as much as the other way around, because we're seeing their defense industry capacity, which we're talking about here at the NATO summit as well, and if the Ukrainians were able to produce their own Patriots, I think that would be a good thing for civilians, and it would be a good thing also in terms of it being more cost effective.
The president's also frustrated with Iran, which is going to be another big topic today, especially given the fact that a Qatari vessel was hit. And of course, they're a mediator in this entire conflict. Is there an inability from Europe because they don't have the hardware to help the United States when it comes to Strait of Hormuz, or there's not a political will to want to do that?
No, there's definitely a political will. You know, we've been on the side of keeping the Strait of Hormuz open from the beginning. Our country, Finland, was involved in a declaration and in the planning of it. And I think the French and the Brits are now talking, for instance, about demining in Oman. So, you know, we have a lot of the capabilities to do it. And of course, on top of that, a lot of the European air bases and military bases were used to service and feed about 4,000 to 5,000 American soldiers.
Some countries said no.
I think in the beginning there was Spain and then a couple of glitches with Italy and the UK, but other than that, thousands and thousands of American soldiers would not have been able to work in the Middle East was it not for European airbase. So I think we just need to understand that we're on the same page with this.
When was the last time you've spoken to the president? Do you feel like you guys are on the same page?
Oh, I mean, we message and speak. I don't remember when the last time was, but you know, we are in constant contact. That's part of diplomacy. But again, you know, I don't have any illusions. You know, President Trump is very strong. He is a strong leader. He does his own things. Sometimes we connect, at other times we don't. Sometimes he listens. Most of the time he doesn't.
When it comes to the broader meeting, this is really a follow-on from the meeting in Netherlands, NATO 3.0. At the same time, you see Europe trying to reindustrialize their defense base. The United States is looking at procurement and potentially withdrawals, and they're in the middle of a 6-month review. Is that going to be one of the big topics discussed here today? And how do you convince the United States to stay committed to the continent?
Well, I think it's in the interest of both Europe and the United States that we both stay committed. So what we're trying to do here is to create NATO 3.0, which basically means a stronger Europe in a stronger NATO. And why are we doing it? Basically in order to salvage the transatlantic relationship. And what we're now seeing is enormous deals actually on the defense industry in the tens of billions of dollars, both in Europe and in the United States. So I think we're going in a good direction with all this. We just need to sort of calm down the language a little bit and make sure that we get things right. As a Finn with 1,340 kilometers of border, you can bet that I'm quite happy that Europe is rearming the way in which we are. If someone would have told me in my first NATO summit in Washington, D.C. 2 years ago that we are now going for 5% of defense expenditure and implementing it, I would have said, I don't think you know your stuff.
How has it changed for Finland? 2 years within the alliance, looking back, was it the right, appropriate move for the country?
Oh, definitely, but I should immediately come out in the clear and say that I've been a long-term advocate of Finnish NATO membership. I think we are a value added to the alliance. In other words, we're a security provider. And the reason for that is that we were not a part of NATO before, so we took care of our own defense. That meant that we have over 60 F-18s. We bought 65 F-35s. Means that we have long-range missiles, air, land, and sea. It meant that we went to the secondary market to buy tanks when everyone else was selling them. On top of this, we have the biggest artillery in Europe together with Poland. So we are in a good place. We were happily taken into the alliance, of course, together with Sweden. So we think that we are, in terms of security, in a better place, and we think that NATO is in a better place, because at the end of the day, it's all about deterrence.
Alexander Stubb, thank you so much for your time today.
Thank you.
That was, of course, the Finnish president, Alexander Stubb, and as I mentioned, known in the American press as a Trump whisperer, European leader that sometimes the president does listen to, he's able to get on the phone with. Certainly helps that he has a very good golf game, Danny.
That he doesn't. Again, it helps with that relationship with President Trump. Anne-Marie, a fantastic conversation. Bloomberg's Anne-Marie Hordern with Finnish President Alexander Stubb. And they were mentioning, again, the U.S. and Europe all on the same page. Here's perhaps another sign that they're on the same page. NATO allies have signed $50 billion in defense industry deals right where Anne-Marie is in Ankara. And we're going to have more from the NATO summit. Later in this hour, we're going to hear from the EU's foreign affairs chief. So more, again, on NATO allies signing a $50 billion in defense industry deals in Turkey as the president has been pushing Europe to be spending more when it comes to defense. Elsewhere, 30 minutes into your trading day, here's where markets stand. We're still moving lower. We're down by 1.5% on the Nasdaq. It's chip stocks that are dragging us lower. It's the safety sectors like healthcare. Those and staples are moving higher today. Majority of stocks are moving higher, but it's not enough to save us. The Philadelphia Semiconductor Index sinks by 5%, while Brent crude moves higher after an attack in Iran on a ship traversing the Strait of Hormuz. Joining us now is Racquel Oden, HSBC Head of Wealth and Private Banking. Racquel, great to see you.
Great to see you.
I gotta say, it feels like narrative ping pong. One day it's semis that are wonderful and great, and we don't care about healthcare and financials, and then you get the reverse of that on a day like today. Yeah. How are you keeping your head straight as the narrative flips back and forth so quickly?
So how we're keeping our head straight, really importantly, is how we're guiding our clients. Because if we are feeling the seesaw, so are our clients. And so importantly, we've really asked everybody to focus on the long term. And what we think about what's extremely positive about this market, while we are seeing a lot of what I call short-term volatility, is specifically looking at corporate earnings. And so you'll hear me kind of be the broken record. Earnings, earnings, earnings. So goes the market, so goes earnings. And as we've seen here, quite honestly, earnings at this point at the end of second quarter is supposed to be 23.3%. That's up since March, which was around 18.8%. In January, it was 14%. So kind of what you're seeing with the chips and everything else is the real surgence of a concentration of what's driving the markets. And it really is AI, tech, and energy. And so what we are really excited about, which is where I think the market's getting even a little bit more healthier, is the widening out of this. Because right now it's been really driven by those major mega tech stocks, right? Mag 7 driving a lot of this. Why I know the widening is actually happening is you see the impressive performance of the S&P, incredibly strong, 10% for the year. But look at the Russell 2000. And that's where you finally have the small caps. And that's how you know things are starting to broaden out. So with the small caps, again, being driven primarily by the tech and AI stocks, but the good news there, they're up 20% this year. So S&P strong, Dow strong, but to see the Russell 2000 now joining the party in the standpoint of the broadening out and really the small caps actually taking a lift, super important.
It definitely injects some confidence. What are your clients saying to you about inflation these days? Because you've two things happening, right? On the one hand, you have an inflation hawk at the head of the Fed. On the other hand, you have rates creeping ever higher. So what are they saying?
So inflation, beginning of the year was 2.4%, now at 4.2%. So clearly a dramatic increase in inflation. But we do know what's driving that, right? It is the Middle East oil crisis. And that's the piece that we all are looking for resolve on. And
is it, though? Are you sure?
Well, if you take a look at it, the primary reason, if you really think about what's critical about this, is the news changes every 5 seconds, as you just talked about. And that's the question of, will the Strait of Hormuz stay open? Will this ceasefire stay, whatever version of it, that we're speaking to right now? We now have the NATO discussion going on, right? So the geopolitical pieces truly are going to drive the short term, what I'm calling volatility, and will drive the inflation, quite honestly. And that's the reason why you're going to see the Fed kind of stay neutral. That's why there's no rate movements. And so what I tell our clients, let's not focus on rate changes as reasons why you're going to make decisions right now, because a rate change is pretty neutral, at least our view is, for the full year. If anything, it's going to be such a short movement of like maybe 25 bits, which isn't really going to cause any major changes. So I've allowed our clients to say, let's compartmentalize inflation with the oil crisis, and let's focus on corporate earnings as you think about sectors that matter and diversification in your portfolios. I'm truly bullish on U.S. equities, but also emerging markets. And that's the important piece we need to realize. Diversification needs to become global diversification. And so if I take a look at Taiwan and Korea, very specifically, Japan's up 39%.
That's brave, though.
It is brave, but it's emerging markets, right? So Japan's up 39%. If I take a look at Korea, it's up 92%. So the data's there telling you that they're really seeing the surgence. And again, what's driving for them as well is tech, AI, and diversification that's happening globally when we think about what's really the important thing that's what I'd say be the wind beneath all these markets is, quite honestly, it's tech.
Is it still diversification if you're diversifying into EM, into markets like Taiwan, where it's basically just TSMC, and into South Korea, where it's SK Hynix and Samsung? Are you not still getting a market that's highly correlated with the U.S., considering the AI trade seems to be driving them both?
Yeah, so what I will tell you, the concentration is within the AI space. But the difference there, what I'd say is important, is the fact that you've diversified within the U.S. So I said U.S. equities overall. I said there's a broadening out that's really happening, which is important. And then you add to that an additional aspect of emerging markets. Doesn't mean you pick all three.
Currency benefits too,
right?
right?
You don't want to pick all three, and there's currency benefits. But the idea here is we've got to not only look at the domestic markets, we have to include the global markets. What I'd ultimately tell you, though, obviously where we are from a geopolitical standpoint, it does and will continue to drive a lot of this volatility. So we always tell people, I need you to brace for the short-term volatility, but I need you to really stay focused on the long term.
All right, Racquel, that's a great point to end on. Thank you so much for joining. Always a pleasure to have you, Racquel Oden of HSBC. Your markets this morning, again, it's a day to brace and go back to your cores and go back to your North Star of earnings of what's guiding you, because we are falling. The majority of stocks are not falling, though. We have seen the equal weighted measure reach a new all-time high yesterday as the market rallied today. We are seeing the Nasdaq leading us lower, down more than 1.5% as chip makers fall after Samsung earnings that were strong but disappointed. At the same time, the Philadelphia Semiconductor Index is down about 5.5% as Brent crude moves higher, just under $74 a barrel after a ship was struck in the Strait of Hormuz.
Well, let's get a look at some single stocks moving at this hour. SpaceX, joining the Nasdaq 100, is going to account for 1.3% of the index. And at least 6 analysts have newly initiated coverage today of the company, with buy ratings, of course.
Elsewhere, Amazon raising at least $25 billion. It's an 8-part U.S. bond sale this week where it'll be funding its AI spending. Shares not too bothered.
And Nvidia is falling after a report that China's DeepSeek is developing its own chip to help power AI systems.
Coming up, we're going to be speaking with Jean Boivin of BlackRock Investment Institute about what he's watching in private credit and credit markets more widely for the remainder of the year. This is Bloomberg Open Interest.
Now to high interest, a look at what's making headlines around the world. NATO allies have signed $50 billion in defense deals at the NATO Summit Defense Industry Forum, underscoring Europe's push to boost military spending. President Trump also signaled the U.S. could let Turkey back into the F-35 program and lift some sanctions, handing President Erdogan a potential diplomatic win, although Congress could still block both moves. Nigel Farage, leader of the UK's Reform Party, is resigning from Parliament and forcing a special election for his own seat. He says voters, not ethics investigations, should decide his future. The move comes as he's under investigation over millions of pounds in gifts and other financial disclosures, though Farage denies any wrongdoing. De Beers is making some of its deepest diamond price cuts ever after years of trying to keep official prices above the market. The move follows a smaller buyer list and comes as weaker Chinese demand, lab-grown diamonds, and excess supply pressure the industry, Danny.
Bonnie, thank you very much. BlackRock Investment Institute releasing its 2026 mid-year global outlook, pointing to durable income as a key theme. The team writes, we like public and private credit with clear cash flows, lender protection, and recovery values. Joining us now is BlackRock Investment Institute Global Head Jean Boivin, who co-wrote the report. Jean, great to see you this morning.
Great to see you.
I want to concentrate on just private credit for a moment, and then we can look at the wider credit universe, just because it has had this microscopic lens attached to it. You talked about the quality opportunities you want to look for. Within the private credit universe, there's been this discussion of, has there kind of been this drift away from quality as people look at putting to work all of this dry powder? How difficult is it in the private credit universe to find the opportunities that are worth investing in?
Yeah, so I think dispersion is becoming more of a theme within that kind of story. But I think it's important to start a bit bigger picture on private credit, which is that we think we're in a global transformation like we probably have never seen before that requires massive amount of investment, infrastructure investment in particular. The world will have to leverage up as a result. Leveraging up comes with risk, and that will need to be managed, but there's no real alternative to really build out the AI or the global infrastructure that are needed to get to a place where we're going to require more funding. And in a structural world like this, I think private credit as a space as a big tailwind to play a bigger role as it happens. So I think as a result, like the space, the asset class, I think is going to be positioned for playing an even bigger role. But it's been growing very fast. Over the last few years, this has been a lot of excitement around it. And I think we're going to get to a phase where dispersion is going to be more important. It's really about getting the right economic exposure. And as we mentioned, like making sure you have the right values and the visibility on cash flows and so on.
But as the AI players look to spend more, it's not just public markets, as you mentioned, it's private markets too. And they're doing a lot of off-balance sheet financing to get this done. Does the use of that, does it reach a tipping point at which it concerns you? Or are these healthy enough companies that it doesn't bother you that this is kind of the construction of lending and borrowing that they're doing?
So I think the bigger AI story and how it connects with the private credit is one where the winners are not known, right? So we're building. So one thing for sure is we're building it, and a lot of resources need to go to fund it. Who is going to exactly win from it? And is it those that are building it right now that will actually benefit from it? I don't think this is clear, and we will not be picking winners on that front. But we think that the credit part of it provides a bit of a diversification aspect to it, which is like you can play into the infrastructure build out without having to pick the winners. And the credit part of it, I think, is likely to be, no matter who wins, like there's going to be somebody buying.
Yeah, I mean, to an extent, you don't care if they're successful or not, right? As long as they keep paying back what they owe you. So what are the red lines for a loan? Is it, the amount that they're spending? Is it where they're spending? Is it what kind of sector they're in?
Yeah, I mean, if we go back to AI, I think like we've done a lot of work trying to reconcile the orders of magnitude that are involved, right? So, I mean, the build-out is like unprecedented. So what kind of revenues do you expect to see to kind of justify that? And I think it's too early for us to throw the towel and say that, like, this is overdone or...
But you don't loan to everybody. Not everything is a bright prospect. So what are the red lines that make you not want to loan some?
So I think the bigger player in that space, scale matters a lot. So, and if there's already a strong balance sheet starting point, that gives even more like kind of confidence on these lending. But we've seen that broadening out now to smaller caps that are benefiting as well from the AI, and I think there's going to be opportunities there as well. But I think the space for this to grow is quite significant, and I think before the market gets to a phase where we really worry about default is some distance from it. So if you are with good managers that can look at good fundamentals, I don't think we're going to get to a place where like the dynamic changes very, very soon. So it's, as a tactical opportunity right now, it remains exciting.
Amazon announced that it would be launching today a $25 billion debt offering. It's already done it once before this year, so this is the second time, already borrowing $60 billion. For the most part, you haven't seen pushback, but there does seem to be elements of it creeping in. I'm thinking of SpaceX in general, which has seen its debt trade lower. Are you seeing more reticence, or at least a slight pushback to some of the huge investment-grade offerings that are coming to market for the hyperscalers? Yeah, there is certainly,
this come and goes, right? Because if you go back to last fall, there was a lot of skepticism about whether these deployments were justified. We wouldn't see the revenues. Now, fast forward 6 months after, we're in a situation where there's been like more proof point of revenues. Whether they're durable, these revenues is the big question, and now we'll need to kind of continue to track that. But the other thing is like the build-out, which was already seen to be the fastest in potentially in history, has been scaled up by 30% only over the last 6 months. So at this point, while there is questions out there, I don't think these are questions to a level that are really leading to a pullback at this stage.
And some of that, increases come from costs, as Ed Ludlow was telling us earlier. Jean, are you potentially foreshadowing some kind of a situation in a few years' time where we see a bunch of this stuff packaged into things like CLOs and just sold off? I mean, you said we're not worried now. Now everything is fine.
Yeah, no, I think this is one of the scenarios that we'll need to kind of keep on the table and plan for and think about. At the same time, I think what's very difficult is that there's no real historical comparison to what we're going through right now. So just like making comparison to what we've. I don't even think I don't even think that 2001 is a valid comparison.
No, 2007. People having 7, 8, 10 houses when it was ludicrous to have that many.
Well, that was a housing story. So I think, you can have a view that maybe there's parallel, but I do think this is very unprecedented. We're talking about probably the biggest transformation we've ever seen in terms of how we do things. AI could be embedded in everything. It might not. So actually, this is one of the big themes of our outlook. It's abundance versus scarcity. It's amazing that in this environment, there are two narratives that are competing. We're going to get to a world of abundance, maybe, but at the same time, we're facing scarcity everywhere.
I wonder, though, if that does mean that there's just a competition for the incremental dollar. And because of the huge build out that we need, because of the money that needs to go towards this, you start to see spreads widen for industries that aren't AI related, just because of the capital intensity needed for the AI build out.
So I think it leads to displacement. And so it's not like the whole economy is going to grow. Again, fastest build out we've ever seen means that it's putting pressure on resources. The non-AI part of the economy will not be able to grow at the same pace if we're really continuing to build that out. But I think it's remarkable we have these two competing narratives. And one of our big stories, these are big calls. These are calls like we haven't seen before. We're betting either between scarcity and abundance. We cannot conclude one way or the other, so we need to remain open-minded. But again, I don't think the historical comparison. I've never seen a world where such a wide range of outcome work.
For what it's worth, Mark Pinto over at Moody's was basically saying this is maybe akin to the railroad build-out, and that's why Moody's and rating agencies even started, because of the huge amounts of debt they were offering.
Yeah,
I don't know. Maybe that's something.
So you can see rhyming in different part of history, but this kind of version, I don't think we can say as a clear parallel.
It's been a wild ride, and excited to continue to follow it with you, Jean. Thank you for joining us, Jean Boivin of BlackRock. Still ahead, Bloomberg's Oliver Crook will be sitting down with the EU's foreign affairs chief. That's coming up shortly. This is Bloomberg Open Interest. Let's get a check on markets this morning. Nearly an hour into your trading day, the S&P falls by 0.5%. The Nasdaq now trading at the lows of the morning, down 2.1%. What is dragging it lower? It is chip stocks. You can see there the Philadelphia Semiconductor Index is down 6.4%. A few things going on for this market to digest. For one, we had Samsung earnings. In the Korean session, they were strong. They beat expectations. That's not enough for this market, considering the huge rally that it and SK Hynix have undergone. Not only that, we have to absorb SpaceX this morning, considering it will be added to the Nasdaq 100. And at the same time, Brent crude prices are moving higher after a ship was struck in the Strait of Hormuz. Bonnie.
Well, Danny, NATO allies have signed defence deals worth at least $50 billion as Europe ramps up military spending. Joining us now from Ankara is Bloomberg Chief Europe correspondent Oliver Crook with a very special guest. Ollie.
Yeah, that's right, Vani. Proceedings are underway here in Ankara, Turkey, where world leaders from the 32 NATO nations have descended to have those meetings. Of course, President Trump is also in attendance. We're very pleased to be joined by the EU's High Representative Kaja Kallas, who joins us here on the sidelines of the meeting in Ankara. High Representative, thank you so much for joining us here. For you, this meeting that we're holding today, 1 year from that critical meeting where we had those 5% pledges, what does success look like here over the next 2 days?
Well, of course, success looks like the investments that the defense, that the countries have made to the defense budgets. And that also translates into innovation and joint work within the member states. So I think we have come a long way, actually.
And thinking about Ukraine, as we always do when we talk, and we always feel like we're at a critical moment from Ukraine, but really we feel that there has been a sort of change of momentum on the battlefield. We see that the Russians are really under severe pressure, both militarily, also economically. What are the next steps now required from the European Union to take advantage of that, and particularly thinking about the sanctions package, the 21st, when do you think that will be ready?
Yeah. Well, we are working on that, and we have the FAC, so next Foreign Affairs Council, coming up Monday. Hopefully we'll get some of it passed there. Why is it important? Because we see, although you say that Russia is weak and weaker than it has ever been before, it is not in the place where they actually come to the negotiation table. So we still need to put more pressure on them so that they would realize that they have to end this war. They have to talk to the Ukrainians to stop it.
And I know generally where you sort of stand on this debate, but there's been a rising debate over the last couple of months about engaging diplomatically with the Russians. We know that Antonio Costa's team has reached out to them. Do you think that it is an appropriate measure now to start thinking about it? And I know that the answer is that the Russians generally don't seem like they want to negotiate, but how do we know if we do not on the European side have any contact?
No, I think the most important is that Ukrainians talk to the Russians. Russians talk to the Ukrainians because the war is between them. And it is about what concerns really the two of them. What we can do on the side is to strengthen the Ukrainian position because we have been on their side from the start so that they would be stronger on the negotiation table, really. And there are some issues that concern also us. Now, what we can't be the ones who are demanding that please talk to us because it's also Russia that needs to realize the things that they want. I mean, lifting of sanctions, for example, depend on the European decision.
And also thinking about the Europeans and also being able to backfill the troop movements that we've heard from the United States. We've been hearing, obviously, that the United States is going to withdraw some troops. We heard from Pete Hegseth they're going to do another review over the next 6 months. Are you satisfied with the European efforts to try to backfill that? Do you feel that there is that safety net there? And is that appropriate? Or is there more that needs to be done there on the European side?
More needs to be done, that's very clear. But we are in constant contact with NATO that all these things don't happen so that we leave a vacuum or a gap really behind. So there are troop movements inside Europe, but it doesn't affect the overall capability of defense and deterrence.
And of course, Trump has linked a number of things also to the activity in Hormuz. There has been discussions periodically about a European role there. Do you see that conversation evolving and moving forward? Or are we still at sort of where we've been over the last couple of months with that UK sort of French-led effort?
We have Operation Aspides that is currently working in the Red Sea. That is also important for the freedom of navigation, and we are ready to, also step in to escort the ships when necessary. But right now, the most important part is the negotiations, the 60 days, and there are, message to the negotiators is that there should be no tolls, no fees for the freedom of navigation.
And also thinking about these sort of respective roles of the European Union and NATO, there's been some critique in the past of the EU of duplicating efforts of NATO. We now have this big industry event here being held around NATO, which is traditionally a sort of European EU role. Do you think that there is a bit of duplication happening? Do you think that is now being reversed in the other way? And do the lines, do you think, need to be a little bit clearer in order to get sort of more effective outcomes on both ends?
We work hand in hand with NATO, really. I mean, because majority of member states in NATO are also the majority of member states in European Union. So we try to help them to fill the capability gaps that they have and the capability targets that they have from NATO. And we are exchanging information and trying to make it as easy as possible to also give our, funding tools to help our member states to actually fulfill their obligations in NATO.
And I also want to think about more broadly the relationship between the European Union and Turkey, who's obviously been a candidate country for a very, very long time. There have been obviously frictions throughout the past. Of course, now Turkey is very much in a very prominent role in terms of its military contribution, and there's less criticism. What do you think this relationship looks like going forward? Do you think it needs to draw closer in the years to come?
Well, we have reached out and have discussions with Turkey on various issues when it comes to migration, when it comes to also connectivity, and of course on the other side we also have issues with their fundamental rights and freedoms and issues that we see also here that we don't really want to see in a candidate country, and we have been very open about this, and also the Cyprus issue that hopefully also the United Nations Secretary General is really pushing forward to have a solution there.
And we also heard from the President of the United States. He's brought up the issue of Greenland. Is that something that sort of concerns you, or do you think that we can sort of move past that?
I think we should look past the rhetorics. I think it is clear that the European Union and all the member states are really, really committed and solidar behind Denmark and behind the Greenlandic people who have the right to choose their own future.
Well, High Representative, thank you so much for your time. That's Kaja Kallas, the top diplomat from the European Union, here at the sidelines of the NATO meeting with all of the issues, including Ukraine, front and center here for leaders.
All right, Ollie, thank you so much. Fantastic interview. Bloomberg's Oliver Crook there speaking with the EU's Foreign Affairs Chief. Let's get a quick check on markets now, just an hour into the session, and we have chips selling off the Philly Stocks Index. Every member of that index is down. Teradyne, the worst performer, down almost 12%, and then Qorvo, the best performer, but it's still down 1.4%. Particularly the memory chips after Samsung beat handily, but of course a little nervousness around potentially this being the top of that trade, and that's bleeding into the US as well. Elsewhere we have energy stocks higher. The energy index, the best performer in the S&P 500 right now. A little bit of addition to energy prices today after potentially an attack in the Strait of Hormuz and around the Strait of Hormuz on a Qatari LNG ship. But ultimately, we have stocks pretty mixed today. The Dow hit a record yesterday. It's just turned lower in the last few minutes. The S&P down 0.6%, and the Nasdaq 100, the outperformer to the downside, down 2.2%, Danny.
Let's get to some M&A news. Honeywell spinoff Solstice is buying Element Solutions in a $14.5 billion deal. It creates a larger supplier of the specialty chemicals used in semiconductor manufacturing. Joining us now is Element Solutions CEO Ben Gilklich. Ben, thank you so much for joining. Congratulations on this deal.
Thank you. Thanks for having me.
And look, I know you yourself and Element, in the past, you've been the acquirer. You've been quite acquisitive. And here we have a spinoff from Honeywell that's not even 1 year old. I think it actually trades at a smaller market cap than you do itself. So why not continue to go at it alone? Why become part of the Honeywell spinoff?
So Element Solutions has had a great run. We've built a great business. We've done a lot to improve our portfolio. And the organic path was really compelling. We were really excited going about our business, making our businesses better, deploying capital in prudent ways. Solstice came along and offered a very compelling value proposition on the short term, but also an ability to accelerate value creation over the long term. We believe these businesses are better together. The combined portfolio is exceptional. There's real synergies. It's an accretive deal for Solstice, and our shareholders are receiving Solstice shares, and so we'll participate meaningfully in that long-term upside.
Can I tell the story that you told me earlier about Martin Franklin?
Sure, absolutely.
How did you two meet?
So I was coming out of business school. This was over a decade ago, and I was looking to partner with someone to build something long-lasting. I sent him a cold email.
There you go, folks. Send that cold email. So what is it about polymers and, success with chemicals and so on? Like, how do you keep doing it when you would think, a company like Honeywell can already do it better?
Yeah, it's a fair question. There are different types of chemicals businesses out there. Element is a specialty materials business. It's a solutions provider. So we don't really make molecules. We work with our customers to buy molecules from other people and develop solutions that solve their pain points. We've got a great portfolio of capabilities and really great people all over the world focused on solving our customers' problems. So it's a people-based business. When I look at what Solstice is great at, they've got great technology, they've got great manufacturing know-how, great market-leading brands in some of our existing customers. So what does this deal do? What are we bringing together? We're bringing together a portfolio that works well together. The products sit next to each other in our customer supply chain. They've got know-how in process engineering, in new molecule synthesis. We've got know-how in taking those molecules and mixing them together in a customer-intimate, solutions-oriented way. So their skill sets make our business better, and our customer intimacy and relationships can accelerate growth for their portfolio. It's a really good fit.
Can we take a step back and just talk about what part of the AI universe that you sit in and what it means to have you together? It's my understanding you're kind of more in the chemicals for chip fabrication itself, and then Solstice is more about data center cooling. What about bringing those two things together is better for customers than just being able to interact with your companies apart?
Yeah, so Solstice has a great refrigerants business, and so data center cooling, when you think about air cooling, that's very relevant. Solstice also has a $400 million electronics materials portfolio. We've got a $2 billion electronics materials portfolio. What Solstice's products are used in electronics materials are for copper deposition, vapor deposition onto silicon, and thermal management. We all know about the incredible problems with heat that these data centers are dealing with. We've got the refrigerants business, but also thermal management materials that are used in chips. We've got a set of solutions that go into thermal management, but other types of products go into copper deposition in other ways for silicon and onto printed circuit boards. So we actually don't overlap in terms of what our specific products do, but we are adjacent to each other. And the supply chain needs partners that can bring materials compatibility solutions to market for them. and we're able to do that.
Well, congratulations on this one, but what's next? Because obviously there's a lot in this space. I mean, the cooling problem itself is going to be a problem for the industry for a decade or two to come.
Unless we go to the moon?
Well, even there, potentially, who knows, you know?
It's a great question. Look, I think that this business is really well poised to continue to execute well, grow organically. There's a lot of integration to do and a lot of opportunities to further support our customers and enable their growth. But this is also a great platform for further growth. We're going to come out of this combination with a healthy balance sheet, and I expect this business to be on the front foot from a capital allocation perspective pretty soon hereafter.
I also just think about how this combined business is so critical for the supply chain, for this very important industry for the United States. And the White House itself has initiatives when it comes to AI and AI supply chains, from chip to data centers. We've seen the White House take stakes in Intel, given funding to companies like IBM when it comes to quantum computing. Obviously, they're a more deal-friendly administration. I just wonder what conversations with this administration have been like, and maybe if in your future some sort of partnership, be it a stake or funding, might be in your future.
Look, this combination is a global business, for starters, and supporting global supply chains. But domestically, it's a critical strategic American asset. Not only are we building and investing in capability domestically for the chip supply chain, but Solstice owns the only American nuclear fuel conversion site. So they do uranium enrichment in Illinois, and that's a very critical piece of American infrastructure for another segment of the economy that's related to this boom here, which is the energy intensity created by data centers. So they're participating and supporting that as well.
We're out of time, but I do have to ask you, David Sewell is going to lead the combined company, so what literally are you going to do?
I'm going to go onto the board of this company. I am very committed to Element and the new Solstice, and we'll be very actively engaged there. And my focus is on getting this done, this integration done well, this deal closed, and setting the business up for success.
Ben, thank you so much for joining us. Really appreciate your time. Congratulations again. That's Element Solutions CEO Ben Gilklich. And catch Bloomberg Deals. That airs every Wednesday, 12 p.m. New York time. In Ben's next deal, we'll get him on there, I promise. Let's get
it won't be long. Him and Martin Franklin are going to get up to something very soon.
I'm sure they will. Let's get a check on markets. This morning, over an hour into your trading day, and it continues to be chip stocks dragging us lower, down 7% for the Philadelphia Semiconductor Index. For one, DeepSeek looking at building their own chips, and Samsung earnings that disappointed. That means the Nasdaq down more than 2% this morning. The S&P, which is within 1% of all-time highs, moves further away, down 0.6%, Vani.
And let's look at some single stocks moving, Danny, at this hour. Rivian diluting. It's offering to sell 75 million shares in order to fund equity contributions related to a U.S. government loan, down almost 13% now.
We're watching shares of Fiserv after a report that big banks have had prelim talks about buying its debit network. Shares up 3.5%.
And Walmart is cutting prices across grocery, household essentials, toys, and apparel as it aims to attract cost-conscious customers. That stock up 2%.
Yep, coming up on the show, Bob Profusek of Jones Day says the M&A stars seem aligned. Well, they certainly were for Ben and Element. He says about that, the second half of the year, we'll discuss. That's up next. This is Bloomberg Open Interest.
So actually a really healthy M&A environment, because what we're seeing is deals of all sizes in all sectors. And it's not just one or two blockbuster transactions, but there's a lot happening, and it's global, it's cross-border. And so for me, that means that the pipeline will continue to refill as those deals run off.
That was Sullivan and Cromwell. Global head of M&A Melissa Sawyer speaking on Bloomberg Deals with me as global deal volumes top $2.5 trillion so far this year. Let's get the view from Bob Profusek, Global Chair of M&A at Jones Day. Bob, always a pleasure to see you. Thanks for stopping by.
Nice to be here.
And look, it has been huge sums that we've seen. The dollar amount of M&A has been incredibly strong for the first half of the year, and it's been mega deal after mega deal. But is that it? Does the rest of the pipeline, does the lower on the food chain deals still look as robust?
Well, the big deal space could hardly be better. In fact, as always, AI has made some astonishing transactions at the top of the heap. The SpaceX deal was $250 billion in one deal.
Wow.
That used to, when I started, that was a year. So yeah, it's very healthy at the large end. And actually, when you stand back from it, the factors kind of support that. Clearly a different view, at least in the United States, of antitrust regulation. There's even been, I don't know why this is, but there's even been sort of a lessening of the impact of FDI and all the stuff you had to deal with in any big deal. So regulatory circumstances, I guess they could be better, but not much. The ability to get capital, it's astonishing. And actually one of the things that's interesting about some of these big deals is they aren't just tapping one source. They're going to sovereign wealth funds. They're going to rich individuals. They're going to all sorts of people.
And it's all kinds of deals, Bob, right? So we're having all of these strategic partnerships, all of these on and off balance sheet deals. But then, of course, you have your regular old M&A. And, you know, media space, for example, has been one huge bucket of M&A. What is the next area that will be in for deals?
Well, one of the things that actually bothers me, sort of even financially, to be candid, is private equity is sort of not totally on the sidelines, but not that active. And maybe that's a function of all this other stuff. The sellers look at these equity values, look at, you know, every day we set a record either on Nasdaq or the stock or the NYSE, and they're asking for too much. Could that be it? Probably something to do with it.
Do you have a message for sellers? Is that what you're trying to say, Bob?
Yeah. How many hard conversations do you have with clients who you say, look, your expectations are just too high and you need to lower them?
That happens a lot but more with the financial advisors who know, I don't mean this in a sort of negative way, but it's going to sound that way, who kind of say that to everyone.
Right.
Because they want people to say, oh, no, I was only doing it at X price. But we've seen some deals recently that have come to market and didn't go. That didn't happen, you know, a while ago. And part of it is there is this expectation of multiple, you know, off the chart multiples. And again, some of it has to do with AI.
I just wonder what it takes to get private equity to capitulate. I had a conversation with Scott Kleinman at Apollo who said at some point it's going to happen. Why hasn't it happened yet? It's been at least 3 years of LPs saying we want distribution, we want cash back, and yet private equity remains kind of sort of frozen.
Because it's really difficult. You got to factor all sorts of things into it. And some private equity deals I've been involved in, even though it's not where I spend most of my time, they've tested the market and drawn back. And that's because in the private capital is fabulous, but private M&A, not so good. In fact, on a number of deals basis, the first half is down almost 10% year over year. And last year was not a great year. Remember, we had well, I forgot what we called the tariff thing, but it was a
Liberation Day? That old thing?
Right. We had Liberation Day, and that brought everything to a stop for a while.
Yeah, exactly. On a scale of 1 to 10, Bob, how concerned are you that something will go sideways with the AI trade and everything will freeze up, not just private equity?
I've listened to people whose opinions aren't to be dismissed. Who think we're heading around the corner to smack right into a market break. 95% of AI companies that start are bankrupt within 3 years. Some of these things that have been done, again, I'm not criticizing it, but the SpaceX AI deal, it's 3 years old. The company was 3 years old. Their CEO was 25 years old. And it's a $250 billion deal. Now, of course, they were taking it in AI juice, not really, but they were taking a SpaceX stock, which is worth, I don't know, it's got an infinite multiple because they don't make money. They've made money a couple of years, but they didn't make money last year, and they were sold for what they were sold for. And guys like me were actually hunting around trying to get in the deal.
Of course, it's your job, that's what you do.
So it's hard to say, but is it just like the financial crisis and mortgages and stuff? No. Is it just like the dot-com thing? When you look at the dot-com thing, it looks kind of almost quaint, doesn't it? And it was, because it was so simple. AI is not simple.
Bob, if we could just end where we started on this regulatory environment. We've had remarkable deals being floated. I mean, the CEO of United going to the White House talking about buying another major airline. Is everything on the table with this administration?
Yes, but there is, it's hard to factor in the political angle sometimes. I mean, just what the president did in respect to the World Cup, you think, he's willing to do that.
Sure, but J.D. Vance is anti-monopolistic too, so you have to wonder what happens in 2-3 years' time.
Yeah. So I don't, and frankly, and Trump won, he wasn't a pushover. Now, it was mostly about healthcare and other things that had political ramifications to it. But it's not just, I know this is not popular, but there's actually some thought behind this. It isn't just this one person's whims. And so almost everything is on the table, given the incredible dial back from the Biden years. Those years were as far left as this we are right in terms of dealdom now. And, you know, the other thing that, as I started with, that puts everything on the table is it's a global market for capital. And people are taking it at decent rates if somebody's in front of them.
Okay, Bob. Always so entertaining speaking with you, Bob Profusek of Jones Day. And catch Bloomberg Deals every Wednesday at 12 p.m. New York time, hosted by Danny Berger.
Thank you for that plug. I will take any and all promos. Coming up, hedge funds posting a strong first half of 2026. David Tepper's Appaloosa notching a 32% gain. We're going to get the details. That's coming up next. This is Bloomberg Open Interest.
Hedge funds posting a strong first half. Lone Pine Capital notching a 43% gain for its investors through June on long and short bets. Meanwhile, David Tepper's Appaloosa returning 32%, fueled by memory chip sector bets. Of course, most of that money is his own at this point. Let's get more with Bloomberg Chief Wall Street correspondent Sridhar Natarajan. So what started working for hedge funds that wasn't working in Q1 and previously?
Look, I mean, obviously we had big jitters in Q1, especially with all the geopolitical issues that the markets were dealing with. So there has been a clear rebound in broader markets. But I also feel what we've seen in the back half of this first half of the year, the second quarter, is effectively that you can see that the smaller hedge funds seem to be more agile and nimble when you have these thematic trades dominating the market and you can make these concentrated bets. These funds seem to be much better positioned as stock pickers than, say, some of the larger, rigidly risk-focused multi-strats. And that's why when you look at the numbers, whether it's at Lone Pine or Tepper, or go beyond them to some of the other names that we've already seen, from Whale Rock to Castle Knight, I think Whale Rock was north of 70%. You're seeing some really big double-digit gains there, whereas the multi-strats are doing good. But 5 to 10% in an environment when some of the other players are doing so much better doesn't seem that impressive.
Momentum, though, has taken a really big turn, and it's some of the worst performance for that strategy. Vonnie mentioned Millennium, and I wonder how those pod shops tend to perform, because aren't they just big momentum bets? They essentially correlate around the best performers, and money continues to go to them, and the things that don't perform well, they lose their money. So how do they perform in an environment like this, where you have this incredible market chop?
Look, I think their biggest selling pitch is that irrespective of the direction of the market, you can be assured that they will be eking out some gains. And even when they have down years, it will not be terrible. Which again, back to our earlier point, when you have these concentrated thematic trades, you can't see the big pot shops pile into your second derivative AI plays, into your memory chip makers and whatnot, into the picks and shovels trade, like the smaller hedge funds have been doing. So they can't reproduce the same kind of returns. But at the same time, they can still flex their muscles, as we saw with Millennium and the pods that are focused on index rebalancing, when you're talking about these mechanical developments where you can make a big leverage play, knowing when the index has to add and remove names, anticipating that, front-running those trades because you know those changes are going to happen and make a lot of money. And that's why two pods at Millennium ended up making $3.7 billion.
Well, they picked the right companies, right? Because you never fully know which ones are going to be the ones that enter. Sri, were there any really surprising trades, be they macro trades or even micro trades that weren't like semiconductor trades or energy trades?
I actually want to focus on Tepper because the most interesting thing that stood out for me in those results, in the Appaloosa results, were up 32% in the first half. Big success with these second derivative plays, such as focusing on these memory chip makers like Samsung and Micron and SK Hynix and whatnot. But at the same time, the most stunning stat here is Tepper was 40% in cash. to use a bad poker analogy, clearly knowing when to fold your hand and stay on the sidelines when you're not sure about something, and really sizing up when we're convinced about something. And that's how half the portfolio played out, and the other half was on the sidelines.
Sri, thank you so much for joining us as Bloomberg Sri Natarajan, and that's it for Open Interest.